It's Zynga's first day of trading, and the stock has already fallen below its offering price of $10 a share. My next guest, though, is optimistic. He's also cautious when it comes to the stock. Max Wolff is a senior research analyst at Greencrest Capital Management. Max, so glad you could join us on the phone. I know you have had a busy week. As far as Zynga is concerned, you were really expecting the stock to pop. It did at the open. Why are we selling off into the close today?
Well, I think it's a risk-off market, and I think people in the market are having a hard time getting their head around the story at Zynga. So it's kind of hard to figure out why something that sells virtual goods is worth $10 billion, especially if you're in a risk-off market, and a lot of investors feel burned by their past forays into the social media space. While we understand that, and it is difficult to figure out why the public would be buying virtual shovels in Farmville when they're having trouble making mortgage and credit card payments, the recent performance of this company and the recent performance of virtual social games suggests people find a time and a way for an escape that means something to them, and Zynga seems to be producing 5 out of the 6 most meaningful social games on the #1 Facebook platform.
Well, Facebook represents about 94% of Zynga's revenue at this point. That seems to be one of the main concerns that some analysts have. Stern AG Arvind Bhatia, for instance. Why is that not a big concern for you? How rapidly can they diversify their revenue streams?
We don't actually think they'll be able to diversify more than a maximum of about 10% off the Facebook platform. The real reason that's an issue is because they have to turn over 30% of their economics to Facebook. That, of course, means they're dependent on Facebook, but there's a bit of a codependency because they're forking over well north of $400 million a year to Facebook. So Facebook doesn't want this relationship to end either. More codependence than traditional dependence. That being said, being the most successful group of applications on Facebook isn't a particularly bad corner of the market to occupy and to own, which Zynga does right now, because after all, Facebook is still growing. It has 800 million engaged users, and it is kind of the place to be on the internet these days.
What makes them better than their competition at this point? I think I was reading your research report, and I guess their one business is bigger than the other 9 competitors added up on Facebook.
Yeah, they're the 800-pound gorilla in this space, so 5 of the 6 top games. We have seen an interesting combination here between a company called PopCap that was acquired by Electronic Arts that put out Social Sims, which was a very exciting and popular game. They have more games with more engaged users. They constantly tweak the games. They're very data-driven, with Mr. Pincus being kind of a data hound, which has alienated some of the game producers, but that notwithstanding, they're constantly iterating and tweaking these games, and it really is a different model. So the games are under constant construction, and it isn't the sort of huge upfront spend and then you hope it's a hit movie-style approach to video gaming that we're used to seeing from Activision and Electronic Arts and others in the space. It's kind of a new, more iterative process that's really optimized for the social platform. And we have to remember that social media is the biggest time spend, and mobile and social seem to be where time, hours, and money is being increasingly routed in terms of people's online life experience.
Now, Farmville seems to be by far their most successful game. The other games, though, they've started to see a drop-off, like Mafia Wars, not nearly as successful. Cityville, although it was successful after the launch, seems to have dropped off as well. Are you concerned that they're sort of a one-hit wonder?
Well, they have a bunch of hits, but it is true the Ville franchise, Cityville, Farmville, and the rest, and now Castleville, has been dominant in terms of its revenue share. We expect them to be able to do 2 things going forward for at least the next 12 months. That is to continue to monetize huge crowds and also to keep people lucratively playing these games for 12 to 18 months, giving them a little bit of a breather to generate the next hit. That being said, it is always possible at any moment that the next huge game is developed by 3 kids in junior high school who have a little extra time and some programming expertise. So it is an unstable space. There are some concerns which we absolutely understand and agree with about Mr. Pincus's 70x voting rights shares, which leaves him with 12% of the shares and 37% of the voting rights, which means he's a bit ensconced as an imperial CEO, and markets in a risk-off environment like this one are not particularly fond of that kind of arrangement.
All right, Max, we appreciate you joining us. Thanks so much. We got to leave it there. That was Max Wolff, senior research analyst at Greencrest Capital Management. And